We briefly touched upon monetary policy in the earlier slide. There are broadly three ways that governments can influence the economic health of the country or region. The first of the three levers that we're going to discuss is fiscal policy. Simply put, fiscal policy is spending and taxes. Those who believe in fiscal policy, called Keynesians, after economist John Maynard Keynes, believe the most direct way that governments can impact households and companies is by spending either public funds or increasing or decreasing the tax that the private sector must pay. We've seen evidence of expansionary fiscal policy in the past with varying degrees of success, from Roosevelt's New Deal after the Great Depression to Obama's Taxpayer Relief Act of 2012. Most commonly, you will see fiscal policy implemented by legislation, not by the central bank. The next policy we're going to look at is foreign exchange policy. An example of this would be China, which pursued a strategy of a semi-fixed exchange rate policy to keep their domestic currency undervalued deliberately as to bolster exports. Lastly, let's focus on monetary policy. That is, the action that a central bank takes to influence the amount of money in the economy and how much it costs to borrow said money. The supply of money and the cost of borrowing is almost always administered by the country or region's central bank, and can either spur or check an economy's growth. Some argue that monetary policy is a very heavy-handed way of controlling the economy, but we shall see in a couple slides how many ways it directly affects economic growth. As we talked about earlier, monetary policy is the responsibility of central banks. So how exactly do they administer monetary policy? Well, it's generally by one or a combination of these three mechanisms. First is policy or lending rates. Generally an overnight borrowing rate for financial institutions from the central bank, and the sledgehammer in the central bank arsenal. Often rumors or the threat of a rate change will be enough to stimulate or quell the market. Open market operations. The government's buying and selling securities in the markets. This controls the supply of money in the markets, which has been further refined now by investments in certain markets and maturities of securities, with fancy names like quantitative easing and yield curve control. And we'll go into those in much more detail later. Lastly is reserve requirements. That's the amount of funds that financial institutions are required to hold at the central bank as a percentage of their total deposit liabilities. Again, this mechanism changes the overall amount that banks may use for commercial purposes such as lending or investing. So let's think about an increase in reserve requirements for a second. If banks must retain a higher percentage of their assets at the central bank, earning a lower rate of return, the rest of the capital they have deployed must now earn a higher rate of return to compensate for the loss of income from the increased reserves, meaning that rates should move higher for loans between borrowers and the banks themselves. As mentioned a couple of slides earlier, policy rates are short-term rates that help central banks control the speed of the economy by changing the cost of borrowing and the amount of money in the system. According to the Federal Reserve, this is the definition of how policy rates affect the real world. Changes in the federal funds rate, which is the U.S. policy rate, trigger a change of events that affect other short-term interest rates, foreign exchange rates, long-term interest rates, the amount of money in credit, and ultimately a range of economic variables including employment, output, and prices of goods and services. Sounds complicated, right? Well, it is. The next slide here shown is from the ECB, and it made my head spin the first time I saw it. So let's try to walk through it together. Lower rates or expectations of lower rates should increase demand for loans and increase the money supply, helping employment, output, and demand. A lower policy rate should also make the currency weaker compared to other currencies and help drive exports. This stimulates demand in goods and service labor markets, which drives up prices and ultimately inflation. The opposite of this also applies when rates are hiked or expected to be hiked. There are also shocks outside of the control of the central banks that must react to as it tries to maintain economic stability. For example, the U.S. Fed cut rates after 9/11 and during the global financial crisis, the GFC, as emergency measures, and the ECB and BOJ both have tried to implement asset buying programs called quantitative easing, or QE, to deal with the same global financial crisis. Ultimately, it is easiest just to remember that when monetary policy is tightened and the central bank wants to put brakes on growth or inflation, they increase rates. When the opposite is true, and the central bank is hoping to raise employment or growth, they loosen monetary policy by lowering policy rates. Now that we've talked a bit about central banks and how they impact the economy via monetary and FX policy, let's look at what happens in real life. Perhaps one of the most famous instances were the policy actions of a central bank and the government backfired was Black Wednesday, the 16th of September 1992. The actions of the central bank and the government almost brought the UK economy to the brink of collapse. Now let's look at this case study. Some background on the UK for those of you who are too young to remember. The European Exchange Rate Mechanism, the ERM, was created to be a precursor to the European Monetary Union and the single currency that exists now, known as the euro. It set an upper and a lower boundary in which exchange rates could vary from member countries. The British government originally declined to join the ERM when it was first established in 1979. Under the Chancellor of the Exchequer John Major and Prime Minister Margaret Thatcher, the UK joined the ERM in October 1990, and the British pound was semi-pegged to the Deutschmark, within a 6% range on either side of 2.95 Deutschmark per pound sterling. Many viewed the joining as politically motivated, but the problem was that the underlying economics of Germany and the UK were very different at the time. Looking at this chart, the blue line is inflation in the UK and the red line is inflation in Germany. In the late 80s and early 90s, UK's inflation was 3 times that of Germany. Now let's look at interest rates. The UK policy rates were already at 10%, as shown on the chart on the left-hand side, in the UK, compared to 8% in Germany. Labor productivity was also much lower than France and Germany, and the UK's economic cycle was looking very precarious. Now going back to the currency for a moment, the pound should not have been able to maintain its relative strength given the UK's high inflation and weak economic fundamentals. Currency traders at the time also realized this and didn't believe that the peg would hold, so they were actively selling the pound sterling short, which is known as shorting. Enter George Soros, a hedge fund manager. He had been accumulating shorts on the sterling for months under his flagship Quantum Fund. By September 1992, he had amassed a $10 billion short position against the pound sterling, which is almost $20 billion in today's dollars. Now, even as more speculators piled into this trade, the Treasury steadfastly refused to raise interest rates or depeg from the Deutschmark. Instead, they instructed the Bank of England to continue using its foreign currency reserves to defend the pound sterling by buying as much as the market was willing to sell to prop up the value of the pound sterling within the ERM band. By 10:30 on September 16, 1992, the Bank of England had exhausted its efforts to defend and announced interest rates increases in the base rate from 10 to 15% to try and entice investors to buy the pound sterling. However, pound sterling shorts continued to accumulate, and by 7 p.m., the UK gave up and pulled out of the ERM. Estimates from the Treasury and the Bank of England totaled a £3.3 billion pound sterling loss on Black Wednesday. Soros and his fund alone made a profit of 1 billion sterling on his shorts. The UK was thrown into a recession as large numbers of businesses failed, and homeowners lost their homes due to the spike in interest rates. The Conservative Party would go on to lose 3 consecutive elections as their reputation was severely damaged. The Bank of England moved to inflation targeting as its main mandate, and it also marked the beginnings of Euroscepticism in the UK. It goes to show that central banks and governments can get things wrong, and the impact on the markets are far greater than any other factors in the market. Also, if they move like the BOE did in raising rates from 10% to 15%, they can crush the markets very quickly.